options trading strategies using Robinhood that work for monthly income. My name is David Jaffe with beststockstrategy.com. I graduated from the Ivy League University. I worked on Wall Street as an investment banker, completed around $5 or $10 billion worth of transactions. And my goal here is to be of service to you and to help you. Please like, comment, share, and subscribe to this video. If you have any questions, you can leave a comment below and I'd be happy to answer it. So I made another video about Robinhood where I actually don't like the platform. I don't think that serious traders should use Robinhood. However, I do believe that beginning traders who want to learn can use Robinhood, right? And there's no problem with using Robinhood except for the fact that it doesn't allow you to sell naked options. And I believe, as I've mentioned numerous times before, that people who tell you that naked options are more risky than vertical credit spreads or other things, they are not profitable traders. Because I can tell you that selling naked options is by far way safer than selling vertical credit spreads because you maximize the amount of credit that you receive. It's a lot easier to roll and manage the position. And it also, by selling naked, it embraces the inherent desire of human beings to be greedy. So it limits the number of contracts that you sell because you have substantially more buying power reduction when you sell naked options as compared to vertical credit spreads. However, this is a Robinhood video and it doesn't allow you to trade naked options. So what can we do? The first strategy is we're gonna sell vertical credit spreads, all right? I do occasionally trade vertical credit spreads. It's probably around 10% of my trades, mostly because I always have a position on an Amazon and I do like to use a vertical credit spread for Amazon because using a vertical credit spread reduces the buying power reduction, and Amazon is a $2,000 stock as of September 2018. However, all of these strategies that I'm telling you, they are good for until the end of time. So it doesn't matter if you're watching this in 2022, 2025, it doesn't matter. This is still gonna work, all right? So vertical credit spreads, what you should do is, if you have a small account, you should watch and have 5 securities on your watch list. At one time, you should only be trading a maximum of 2 securities, preferably 1. So you have 5 securities on your watch list, maybe Facebook, Lockheed Martin, Boeing, PayPal, and one of the gaming stocks, let's say ATVI, right? Like Activision Blizzard. So you have those 5 securities on your watch list, and at any one time, you're gonna have a position on maximum of 1, maybe 2, but I would say 1, you only have a position on it on one of those securities at any one time with a small account. So Facebook right now is trading at 175. I think that's a relatively good time to enter in a new position on Facebook. Let's say it's trading, it falls to like 172. You can then sell a put with a strike price of 158, and because this is Robinhood, you would then have to sell a vertical credit spread, so you'd have to buy a lower price put. I always focus on the entry point, whether I'm selling a vertical or a naked option. The higher price put that I'm selling remains the same. So I would sell a naked option with a strike price of 158, and if I was turning it into a vertical credit spread, I would choose the same option, the $158 strike price for Facebook. Now, to turn it into a vertical, I would probably choose like the 150. All I'm doing with the vertical credit spread is I'm trying to choose an option that would reduce my buying power reduction that also doesn't cost that much money, all right? Because you know that with 99% certainty that vertical credit spread, the option that you're buying, is going to be wasted money. So you might as well turn Facebook from a $158 stock to an $8 stock, which means that you're buying the $150 put, but you're selling the 158. So the difference between that is $8. But at the same time, you don't want to buy a lower price option that is going to substantially reduce the amount of premium that you receive. So for example, if you receive $1 per share by selling the $158 put, then you want to make sure that the $150 put that you buy doesn't cost any more than like 15 cents. That means that on a net basis, you will collect 85 cents for that trade. All right. The second strategy that you should use is you have to make sure that you allocate your capital and you have very good capital efficiency. For example, let's say you sell that vertical credit spread on Facebook and it expires in 6 weeks. Then let's say Facebook goes up to $185 2 weeks from now, and that credit spread that you sold for a net dollars of 85 cents a share is now trading at 15 cents, meaning that you can buy it back, and for 15 cents you can realize, let's say, 85 cents. So you've been able to realize around 80, like 80% of the profit, yet you've only had to spend and have your money be at risk for half the time. So you got 80% of the profit in only half of the time, and if you wait the incremental 3 weeks, you're only going to get the incremental 15 cents a share. In my opinion, that is not a good usage of capital. You should close out that position. You should then look at your watch list, and maybe Goldman Sachs is trading down from 235 and it fell to 220, or maybe ATVI has fallen, or maybe Boeing or Lockheed Martin has fallen. Then you can enter a new position at that time. Remember, this is very simple. We want to keep things as simple and easy as possible. And you can make money in Robinhood, but you shouldn't be buying options. You need to sell vertical credit spreads in Robinhood, manage your capital efficiency, and ignore all the noise. One major flaw that I see in Robinhood is it's become so popular that I'm part of the Facebook group just because I'm very interested in human behavior. And I see people taking screenshots of the winning trades that they make by buying calls. Buying calls is like the most idiotic strategy because you're just gambling, right? In order to make money in the stock market, you have to be the casino, not the gambler. So again, this is a great way for you to make consistent money. You can make 30 to 50% every single year by selling vertical credit spreads for the rest of your life, and you will not be taking that much risk. My name is David Jaffe. You can go to beststockstrategy.com and receive $400 worth of free training. You can enter in your email, or if you want to subscribe to the Trade Alerts product, you can do that. Please like, comment, subscribe, click the little bell, share this video as well. My job and my goal is to be of service to other people. And I'm not doing that because I'm completely altruistic. No, I'm actually doing that because I'm selfish. I know that when I help other people, I'm helping myself, and it makes me feel good about myself. So if you have any questions, let me know. I'm here to help you. And thanks again for your attention.